Good evening, everyone, and thank you for joining us. The webinar will begin shortly. So good evening, everyone, and thank you for joining tonight's workshop, Home Buying for Rookies. My name is Ryan Keene, and I'm Vice President of Lending here at Ardent. We've hosted several virtual workshops over the last 2 years, and I think you're really going to enjoy tonight's presentation. Occasionally, technology can throw us a curveball, so we do ask for your patience if we run into a temporary issue with the webinar. If you need to ask a question during the workshop, please click the Questions tab and type in your question. The photo to the left is the screen of an iPad, and the photo to the right is the screen of a desktop. We have Lisa from Ardent's marketing department on the line who will relay the questions to our speakers during the Q&A session at the end of the presentation. Please know that this workshop is being recorded, and we will post it on Ardent's website within the next few days. Tonight's presenter is Damien Manno. Damien is AVP of Real Estate Lending here at Ardent. And Damien has been the go-to guy for members looking to buy a home since 2010. Damien enjoys guiding members through the mortgage process and tailors his service and recommendations based on each home buyer's individual circumstances. Damien, the floor is yours.
All right, everybody. Apologize, first of all, for the creepy photo. I haven't aged well in the past year, but also for the fact I have a head cold that has migrated to my chest. So there may be some coughing and maybe occasional drink breaks of this, but I will try and keep them to a minimum, and I hope I'll still be able to make it worth your while. Well, if you are anything like me, during the pandemic, I became addicted to cooking shows. And one of the things they tell you, especially if you're going to go grocery shopping and you're on a budget, is you better make that list before you go to the store, because otherwise, when you get there, you will see a million things that you don't need, and now you suddenly need them. And they're going to fill up your cart, and by the end, you're going to spend twice as much as what you thought you were going to when you went to the store. And that's a good life lesson for us, because when it comes to home buying, it's a very similar process. There's a lot that goes into it, a lot that you need to take into consideration before you go shopping for an actual house, so that you can prepare yourself in a way that you're looking for and getting what it is that you want and what fits your needs, and you're not wasting your time. And also, you're able to adjust your expectations according to what it is that you're able to do. So we're going to go briefly through what is a pretty substantial process, and we're going to try and make it as painless as possible and as easily to understand as possible. So bear with us, and we'll try and make it interesting for you, okay? So our webinar, Unlocking the Door to Your First Home. I'm just waiting for my clicker to work. Hold on. There you go. All right, our first technological hurdle. So there really is a roadmap to home ownership. There's really 5 steps to take from start to finish that's going to prepare you through and then end up with you at your new home, the one that you've been dreaming of. Now, the first is building a strong financial foundation. Then you're going to want to understand what home loans are, how they're structured, what you should expect to pay. From that point on, you go to shopping for a home, then submitting an offer, and then closing on your new home. So we're going to take these, we're going to break them down one by one. And you wondered, well, why is building a strong foundation come before shopping for a home? Because sometimes it just seems like, why don't we just jump on the internet and start looking at homes we like? Well, there's a lot more that goes into it. So let's cover that first point. Building a strong financial foundation. Now, you're probably going to hear a lot about credit reports and scores. What does that mean exactly? Why are credit scores so crucial to the mortgage approval process? Well, credit scores and in turn the credit history that you have is really going to be a determining factor whether a lender feels confident enough to lend you the funds that you're going to need for a mortgage. Because a mortgage is a little different than it is if you're getting a $500 credit card at an Aeropostale, or you're buying a car for $20,000, but it's a 5-year loan. In most cases, most buyers are looking for a 30-year loan because it's going to keep their payments in a manageable and within their budget. So when it comes to a 30-year loan, a lender's going to say, well, we've lent you that money for this length of time. How do we know you're going to be good for it? What have you done in the past? Are so crucial to the mortgage approval process. They also impact the mortgage rate that you're going to pay. The higher your credit score, the lower risk you're considered to be, so the lower rate you may qualify for. This can impact your payment quite significantly, whether you have a high credit score in the 700s or a credit score maybe in the middle 600s. It could be the difference of a full percentage point in your interest rate, which could end up being hundreds of dollars a month in your payment. So by setting that good foundation early, getting your credit ducks in a row, as it were, early, you're going to put yourself in better position to qualify for what it is that you're looking for. Now, the FICO score, the Fair Isaac credit scoring model, the range is typically 300 to 850. The higher, the better. Most mortgage lenders are going to require a score of at least 620 on your median credit score. So what we mean by median is when you apply for a mortgage or a mortgage pre-approval, the lender is going to pull 3 credit reports from Experian, Equifax, and TransUnion. And then what they're going to do is all 3 of them have slightly different scoring models. They're going to take whatever that middle score is of them, and that's how your loan is going to be based off, or that's what your qualification is going to be based off of, that median score. Now, there are also non-traditional credit scoring opportunities where you can self-report, like rent, insurance, utility payments. You can have that reported on your credit as well to kind of build up that history. In some cases, you may be able to provide additional information about rent that you've paid consistently with a landlord, maybe for the last 3 years, and they can kind of write a letter of recommendation for you. That's not going to necessarily impact your credit score, but maybe a lender who sees manage credit well, but you haven't managed credit in high dollar amounts before. You have a $500 credit card and you've had it for 3 years and there's been no issues with it. You've had 2 auto loans before for not very high dollar amounts. Good payment history, but sometimes it helps to know, well, they were able to afford and pay their rent over a continuous period of time. Their landlord said they were never late. So that can kind of impact or make a lender feel a little more confident about the decision they're making, especially if someone has what's called a thin credit file. They just don't have a ton of credit history or a lot of different types of credit. So in regards to credit reports and credit scores, there are some tips for keeping your score high or raising your score from what it is currently. The most obvious of which is continue to make your payments on time. What you don't want is a lot of 30-day late payments coming up on your credit report. Does a lender report you credit, or does a lender report you as late if you're a day late? No. It's if you've missed the payment for 30 days. At that point, it's going to appear on your credit. And those can be hard to live down, especially if there's multiple ones of them. You want to put as much distance, if you've done that before in the past, you want to put as much distance as you can from that time to the time that you're actually applying for something. So you don't want to be delinquent 3 months ago and want to be applying for a mortgage if you've been delinquent multiple times. You kind of want to get yourself squared away there. So making payments on time is the first thing, because at that point you've proven you pay things as you've agreed to pay them. Also, paying down balances. Why is that important? Well, especially when we're talking about credit cards. Let's say you have a credit card for $1,000. If you use that credit card each month and you've spent it all the way up to the $1,000, and then you make the minimum payment each month, the balance isn't going down, and you basically used up all your credit on that account. If you've done that on multiple accounts, it's going to give a lender pause, and it will impact your score, because it looks like when you take out credit, you need it. You need it to survive on a daily basis. It's almost like additional income for you, and you need that so that you can get through your monthly budget. So use them when you need to. Pay them off in full each month if you can, or have a plan in place to pay them down more than the minimum payment. That's going to help your credit score as well. The other thing is keeping older revolving accounts open. What does that mean? Let's say you have a credit card that you opened in 2012 that you haven't used or don't use that often. Just close the account. Close the account and get rid of it. You won't have it on there. Not necessarily the best thing, because if it's from 2012, it's now given you at least 10 years worth of good credit history. You have had no latenesses on it. You may not have really had any balances on it. You don't use it, but you've had it over a long period of time, and that factors into the credit score so that it's going to increase it because you've dealt with debt over a longer period of time and demonstrated yourself responsible in handling it. So that has a good impact on the credit score. You're also going to want to limit your credit applications. What does that mean? Well, if you can pay for things cash at the time that you're really starting to look for a home, do that. Don't continuously apply for multiple credit cards or additional loans like personal loans, auto loans you may need to apply for, and that's a secured debt, so it gets viewed a little differently than something that's unsecured. And the difference between secured and unsecured is that a secured debt means if you don't pay it, the lender can go get whatever it is that you took the money for. An unsecured is the lender basically has to write it off, and it's considered a loss at that point. So unsecured debt is viewed as riskier. The more unsecured debt that you're applying for, the more it can impact your score in a negative way, because it looks like you need to borrow money and that you're really not able to meet your financial obligations with just what you earn. You need a little extra each month. So if you can, limit the credit applications prior to approval, because the more inquiries you have, the more times you've applied, it does impact your credit score. Now, it does take advanced preparation when we're talking about applying for a mortgage or considering to apply for a mortgage. And this is a good rule of thumb to check your credit report at least 60 days before you're applying for anything. How do you do that without actually having your credit pulled and then it turns out to be an inquiry? Well, you actually are able to pull your credit report free once a year at annualcreditreport.com. It's not going to give you a credit score, but it will give you a full credit history that's being reported to all the agencies, TransUnion, Equifax, and Experian. The reason you want to do it, preferably 2 months before applying, just to check, is to make sure there's no errors on there. There's a collection account on there that you weren't aware of, maybe a medical collection, or perhaps a debt that's not yours at all. Or maybe you did make a payment and one of the creditors is reporting you in error that you have been late. You want to get that taken care of in advance so that when you're ready to apply, you don't have to go back and fix this. Errors on credit reports don't get fixed in the snap of a finger. Sometimes it can take up to 30 days for a creditor to report the correct information. And if you're anxious about buying a home, if you've got a lease coming up, if you're looking at the type of buying market that we're in right now, 30 days can really set you back. So show some advanced preparation or try to be prepared in advance and recognize the fact that sometimes things could appear an error. Just kind of check that one off the list of things to worry about in advance. The next question you're going to have is, how much cash am I going to need? You've got your credit in a row, but now we're talking about what's it going to cost you to get a home. Down payment. What are the closing costs going to be? What are the startup costs going to be? Repairs, renovations, furniture. You moving into a place where you're going to need everything brand new, Are you going to be able to carry things over and take it over to you with you? If you're buying a home that's a fixer-upper, do you want to factor that into your costs? Or are you buying something that's move-in ready and you're really not going to have to worry about maintenance for a period of time? And then it's always good to have a rainy day fund. Things happen. It's just a fact of life. And they will often happen as soon as you own the home. And it may be something that becomes very stressful. And if you spent your last cent getting into the house, you may find yourself in a position where now you have to borrow suddenly to be able to cover some of these things. So if you can plan for that in advance, that's always best. Now, where can you get your money from, the cash that you need? It can come from savings. In some cases, if you have a retirement plan at work, like a 401k, your employer may offer you the ability to tap into your 401k to take out a loan to allow you to purchase your first home. It can also come in the form of financial gifts from direct family members or household partners, people who will be living in the home with you, can contribute in that way as well. And then other assets, such as stocks, if you have them, mutual funds, any type of retirement assets that you may have, you can take those into account as well. What you don't want to do outside of a 401k is borrow the funds. Most lenders will not allow you to borrow the funds if you took out like a personal loan and then put the money in your account and it's been in your account for less than 60 days. They're going to ask where that money came from. And if they found out you borrowed it, not only are they going to take that payment on that loan into account, but they're also going to wonder, do you have the ability to save and really keep your head above water if something does occur with the house after you take ownership of it? So the next step is getting pre-approved. Why do you want to do that before you go shopping? Well, getting pre-approved is really going to establish what the top of your price range is. A pre-approval is going to be vital, especially in this market, because unless you are willing to pay cash for a home, meaning there's no mortgage required and you have the ability to pay cash in full for the house, a seller's not even going to look at your offer because they're going to want to make sure that you have the ability to get the mortgage that you say you do. Because they're going to get plenty of offers from other people who already have a pre-approval letter in hand and have demonstrated to a lender that they have qualifications, both credit and income, and also asset-wise to make that offer. This in turn is going to strengthen your negotiating power because you're going to have the ability not to make an offer on just one home, but multiple homes if, for whatever reason, any offer you make is not accepted. It's something that's a blanket thing and can carry over to each offer you want to make. And then it really speeds up the home buying process. You've basically done your homework and the heavy lifting with the lender in advance of even going shopping. This market has been super fast. You can wind up going to an open house, fall in love with the place, you walk out of there and your agent says to you, if you want this, I know there's offers coming in right now, you need to put in an offer tonight. At that point, if you've done all of these steps up to this point, you're going to be able to make that offer that night. And from then on, it can happen really fast if your offer gets accepted. So do yourself a favor and take care of this homework first. So, how do you determine what you can afford? And why is it important to do that? Because it's really, really hard to enjoy a house if you can't pay the mortgage or if you're straining to pay the mortgage. So what do you have to do? You do have to create a monthly budget, a budget that is specific to your circumstances. Now, when a lender is pre-approving you for something, they're going off of what's on the credit report and then any other outstanding things that may not appear on the credit report, but that a lender needs to know about, such as if you have child support or alimony payments, or if perhaps you're in some type of a payment arrangement with the IRS or something where you have to make regular monthly payments, but it's here on the credit report, that's still part of your overall monthly budget. A lender's going to want to know about that. What doesn't a lender want to know about? A lender doesn't know what your food budget is, doesn't know what your insurances cost, your cell phone, doesn't know how much your Comcast bill is, how much you pay in electricity. They really don't know how much you pay in childcare. so that you can go to work. So a lender's going to see part of the picture, and they may tell you what you're qualified for based off of the figures they're seeing. But if you're paying $1,100 a month in child support or child care that they're not seeing, you know that maybe that higher threshold that they've approved you for is not necessarily what's going to fit your budget. So this is where you really need to be honest with yourself about your situation. In regards to mortgage payments, and we're going to expand on what we're talking about here in the next few slides, but what all of the housing costs are that are involved in a mortgage payment. So it's really broken down into 5 areas. There's the loan payment, so that's the principal and interest payment on the funds that you've borrowed. You're going to have property taxes. Most lenders are going to want to escrow or include your property taxes as part of your monthly payment to ensure that when you make that payment, they go ahead and pay the taxes as they come due, so that there's no concern that those taxes aren't paid and there would be some type of a tax lien against the property. Insurance is also part of the mortgage payment. So this can include 2 types of insurance. Homeowners insurance, which is the coverage to rebuild the home or to repair the home in the event that there's damage to it. And then there's private mortgage insurance for those borrowers who are putting less than 20% down. And we'll get a little more into that in a few minutes. But most lenders will require that there's an additional insurance policy that protects them as a lender if you're putting less of a down payment. You're also going to have to take into consideration if you're buying a townhome, a condo, or even if you're buying a single family home but in a community, there may be homeowners association dues as well that are not necessarily part of the mortgage payment, but you have to pay those dues so that there's no lien put against the property so that you can be part of that community. So that's something to factor into your budget as well. And then there's maintenance. Now, maintenance is not part of the payment, but maintenance is something that's going to happen. So you're going to need to, if you've got a lawn, you're going to have to start worrying about mowing it. You may have to worry about different equipment to keep the house up. There may be any number of factors that you need to take into account that things in the house are going to break at some point in time, and it may happen sooner rather than later. So you want to be able to have the flexibility in your budget to be able to sock away a few dollars here and there, and prepare in advance for those types of events. So now we're going to move on to our next part of our roadmap, which is understanding home loans. Now, as we discussed briefly before, the mortgage payment components are that loan, the principal and interest balance. So in the beginning, especially if you're talking about a 30-year loan, most of it's going to interest when you make your payment each month because of the fact that it's the time that your loan is the highest and you basically just started off. But as you pay each month and as the years go by, more of that's going to go to principal. And then eventually, if you come to the end of or towards the middle and end of the loan, you're going to see that most of it is going to principal and paying it off sooner. And the loan is amortized that way. It's calculated so that that loan will pay off in 30 years if you make no changes to it and continue to make payments as needed. All right, I don't know what happened there. But here we are, back again. How are you? So next, we'll move on to likely escrowed payments, which is made up of property taxes, which we discussed, homeowners insurance, and then that private mortgage insurance that if you have less than a 20% down payment. Now, private mortgage insurance is interesting because of the fact that that's also going to be impacted by your credit score. So the higher your credit score, the less your homeowners or your mortgage insurance premium is going to be. So you'll be in a better position. Also, the more you're putting down, even if you're putting less than 20% down, your PMI would be less if you're putting 5% down rather than 3% down. Or if you're putting 10% down, it's going to be less than if you put 5% down. And if you put 15% down, it'll be less than 10%. So the more you're putting down, the mortgage insurance premium can be lower as well. And with conventional mortgages, PMI traditionally can come off automatically without you having to refinance the loan. Once there's enough equity in the home, you're able to apply to make sure that there is enough value in the home, that there's that 20% equity gap, and then the lender can agree to remove the insurance. There's some loans, as we're about to talk about, that don't allow you to do that. But in most cases, if it's a conventional loan, yes, you can do that. So let's move on to types of loans. The most popular one is the fixed rate mortgage. The interest rate and the payment does not change over the life of the loan. Now, if you pay it off or refinance it early, obviously, if you're going to finance again, you're going to be subject to whatever the current market rates are. It doesn't carry over from one place to the next. But with a fixed rate mortgage as well, keep in mind that even though the interest rate and the principal and interest payment do not change, your monthly payment will adjust as you live in this house, because your property taxes almost certainly will go up. Hopefully they'll go down. And also your homeowner's insurance premium may vary. You may wind up having various homeowner's insurance providers over the years, because you'll get increases with one policy and another provider will offer you something lower. So there will be fluctuation in your payments over time, because those two costs will change. They do adjust by their nature. Another type of mortgage is the adjustable rate mortgage, or ARM. So what's an adjustable rate mortgage? Well, as it says, it's adjustable. The interest rate and the payment will change at some point during the period of time that you have the loan. Typically, if it's, for example, a 5/1 ARM, it means that your interest rate is locked for the first 5 years of that term. And then after year 5, if you've done nothing different with the loan, you haven't refinanced into a fixed rate, if you have it loan still, the rate can adjust up or down, dependent on what the treasury yields are at that time. You usually get at least 6 months advance notice when the rate is going to change and what it's going to change to give you time to determine whether or not you need to get it into another type of loan. But it's not something that the next week a lender sends you the letter and now your rate has changed and now your payment's $200 higher. But it is something to keep an eye on. Most borrowers, like I said, prefer the fixed rate mortgage option because they like what they consider to be long-term security. The adjustable rate mortgage option can be an option for borrowers who may not have absolutely perfect credit, so they may not qualify for a fixed rate with certain lenders, but the lender may be willing to approve an adjustable rate mortgage to allow them to get back on their feet credit-wise if they think that, other than that, they have sufficient assets and payment ability to repay the loan. Now, typically with an adjustable rate mortgage, why it becomes enticing to borrowers is that usually that interest rate is low in the beginning and then it adjusts and increases later. So about a year ago with COVID, the rates were so low with fixed rates that fixed rates were actually lower or at the same level as adjustable rate mortgages. So nobody really wanted an adjustable rate. But now we're back to the spread where adjustable rate mortgages could be as much as a quarter, 3/8, or even 0.5% lower than a fixed rate. And it may allow you to afford more payment in the beginning or give you that flexibility in the beginning to have that lower payment, especially if maybe this is just going to be a starter home for you. You're moving into a townhome. You just got to get out of that apartment, but you don't plan to be there very long because you're going to start a family. But this isn't your perfect home just yet. But you figure in 5 to 7 years, I am going to be looking to move on. Absolutely. And so why pay a higher interest rate than you have to if you know that your circumstances are going to require that you're going to be out of that property before the end of the term. Now, there's other types of loans as well, which are government-sponsored loans. FHA, which is typically for first-time home buyers, but mainly for those also who have perhaps a little more credit challenge than some others. When we talked about before that a lender usually wants to see a credit score of 620 or higher, the majority of lenders that are doing conventional mortgage options, which are that fixed rate and that adjustable rate up top, those are the conventional mortgage options. FHA also offers fixed rate and adjustable rate, but FHA is government backed and they offer a different product that allows them to assume some of the risk for borrowers that may not have perfect credit. So an FHA loan will allow for as little as 3.5% down for first-time buyers. In some cases, they may allow a first-time buyer to roll in some of their closing costs into the mortgage to reduce their out-of-pocket costs. There is a caveat to that, though. When we talked about that mortgage insurance, FHA has mortgage insurance, but FHA mortgage insurance is typically higher because the risk is considered higher. The other thing is it never comes off, not ever, until you pay off this loan. Whether you sell the house or you refinance it, you're not going to be able to get it off until you're out of an FHA product. There's also VA loans for veterans. They do have specials for qualified veterans that allow them to put, in some cases, as little as 0% down and just pay closing costs. And if someone is a veteran, it's always a good idea to at least take a look at what that benefit is and see if it makes sense for you. And then there's USDA loans. So that's really in particular to the type of house that you're looking to purchase and where it's located. If it's in an area where a USDA loan, it's considered a rural area like that, and they can cover that neighborhood, and they offer those types of loans, you can always explore those options as well. Now, what does Ardent offer? Ardent offers conventional mortgage financing. So we do the fixed rate mortgages, we do the adjustable rate mortgages. We do not offer FHA, VA, or USDA. So those are going to be specific to different lenders who do offer those programs, and not everyone does. So what do we offer? Well, for first-time home buyers, we have a program that enables buyers to put down as little as 3% of the purchase price. We also offer rate protection, which what it does is allow you to shop for up to 6 months without your pre-approved rate increasing. Why is that significant? Typically, you can't lock your mortgage rate until you're actually under contract to purchase a property, and you have to be within 60 days of closing. That's when you can lock in your rate. But with the market the way it is, with inventory as scarce as it is, we recognize that it may take a little longer for you to shop around. And if you have an interest rate that climbs 0.75% or even a full percentage point from the time that you apply for a pre-approval to the time that you finally find the place and want to put an offer, and now you realize that payment's no longer in my threshold that I had budgeted for. This rate protection allows you to have some of that protection so that the rate that you would have qualified for at the time that you applied for the pre-approval, you can have that rate for up to 6 months so that you have the time to shop. Now, we do have to pull your credit report after every 90 days just to make sure that nothing new has popped up and that you still qualify for that rate. But if so, you get that rate, and there's no additional fee for that service. You also get $300 off your closing costs, which every little bit helps when it comes to being a first-time buyer. I'm sure you have $300 you could use, put better use than just paying loan costs, so that you can just so you can get the loan. And I can trail off into my sentence and not know what point I was trying to make there. So we'll move on to shopping for a home. So now that you've gotten pre-approved, now that you have an idea of what a loan is going to be structured like, that next step is finding a real estate agent. Now, in many cases, borrowers will do the exact opposite. They'll go find a real estate agent first so they can start looking. And then the agent says, "Are you pre-approved?" And they say no. And they say, "Well, go find somebody to pre-approve you first." Or they'll recommend somebody. But really, you want to find an agent after you've gotten your ducks in a row. So who should you look for? Well, you can ask for referrals from family members and friends, people that they trust. You want to find agents that are familiar with the area that you are interested in. You also want to comparison shop. Not all agents are the same. And you absolutely want to avoid using the seller's agent. The reason being, the seller's agent, their primary concern is to represent the seller. So they're not necessarily going to have you as the buyer's best interests at heart. They're just looking to unload that property for the seller, and they may structure a deal in such a way that it was not beneficial to you and doesn't give you the ability to get out of the deal if at some point you get cold feet and it just doesn't seem like the right thing for you. But finding a real estate agent is also a very personal thing. So go with your gut. If you're talking to an agent and you should get the sense that you feel like they know what they're talking about and they're not selling you a bill of goods. You do want to ask about reputation, but if something seems off, move on to a different agent. Find somebody who is going to represent you in a manner that you really would appreciate and have the right to expect. So to help you find an agent, Ardent does have the Home Advantage program. It's a partnering we have with CU Realty that allows you to access for free online tools to assist with your search. So it gives you the most up-to-date listings in the area, because not everything you look up online is going to be as up-to-date as what these listings will be. It's also going to give you access to a network of vetted, experienced real estate agents. So these are agents that are credit union approved, that have a good reputation, that go through a pretty rigorous training program and expectation level, that they have to provide quality service, and they have to continue to do that over their years of service as well, so that when a credit union refers people over to them, they can feel like they're in good hands. And the benefit to you as the borrower, if you pick someone from the Home Advantage program, is that that agent will actually give you a rebate up to 20% of their commission that they earn on that. They're going to give you that so you can put that money towards the closing costs because you used somebody from this list. And that can be a big benefit, because it brings out in that example, you could get a reward of $1,200 on a $200,000 home purchase just from the agent's commission. As the home buyer, you're not paying that commission. The seller's the one paying the commission. So it's actually like getting some of the money that the seller is paying his agent or her agent and your agent. Some of that money is going to you so you can apply it to your closing costs and have more cash in hand when you actually are moving in. So what types of homes are we talking about? Well, the primary types of homes here are single-family residence. So it can either be a single home that's standalone, it's got a yard and everything. It could also, a single-family residence could also be considered something like a row home in the Philadelphia area as well. Something where there's not a homeowners association involved with it, but the homes are just attached. There's also duplex or multi-unit buildings. So duplex is a property that has 2 livable units. Multi-unit, most lenders, the maximum they will allow you to purchase is a 4-unit property, and you would probably have to, if you're a first-time buyer, you're going to have to be living in one of those one of the units as your primary residence. However, with duplexes and unit buildings, that 3% down payment option is not available. So sometimes you have to put 5, 10, 15, maybe even 25% down if you're looking for a property that has multiple units to it so that you could rent them out. There's also planned unit development. So what is that? They're also called, the abbreviation is PUD, but it's really any home that is part of a homeowners association. Now, homeowners associations can be big, they can be small. What do I mean by that? Well, there's some homeowners associations where all the houses must be uniform. They may be attached in the form of like a townhouse. The roofs are all the same color, the siding is all the same color, and everything has to remain that way by order of the association. But the association charges fees for the common grounds of the area. So whatever the maintenance is, the lawn mowing, the sidewalks in the event that there's an ice storm or something like that. Anything that is community owned, you will pay association dues for. and the association will take care of that. That being said, in a planned unit development, you may also be told what you can and can't do to the home, your own home, that would be allowable to the association. I'll give you an example. My home is part of an association. Now, we only pay, I think it's $11 a month for our association. So the association itself is not large. It doesn't cover a lot of area, but the association has bylaws that determine whether or not I can cut down trees in my community, because they want to keep the old forest, the oak tree look to the community. So unless there's something that's damaged or going to threaten my home, I have to apply to them to get permission to do something like that. Some planned unit developments are okay to deal with. Others just become a pain and a nuisance, and you may never want to do something like that again once you've run afoul of them. So that's really something to take into consideration as well. There's also condominiums. So usually those are stacked buildings. You might get one floor, almost like an apartment level building. Condominiums typically will have higher association fees than a townhome or even a single family home that's in a planned unit development. The reason being, with condominiums, you're responsible from your insurance standpoint for maintaining the interior of the unit. But the common areas, the outside of the building itself, the roof, that's for the condominium association to take care of. So if the roof blows off, the condominium association has to take care of that. The siding is damaged, they take care of that. The parking lot needs to be done, they take care of that. But that also means that your fees are going to be a little higher. Taxes do tend to be a little less, though, in condominiums. So it kind of balances out a little bit there. It's just be mindful of the fact that if a condominium is going to be something that is going to be temporary for you, it's just going to be a starter home and then you're going to move on. Just keep in mind, values can kind of drop substantially while you're in a condominium. They don't increase as highly or as quickly as, say, a townhome or a single family home. So you want to be mindful of that, that if you think you're buying one with the idea that it's going to suddenly be $50,000, $60,000, $70,000 more in 2 years and you're going to be able to sell and move on to the next place, you want to talk to an insurance agent about that to get a real estate agent about that to get a sense for what those are going for in your community. So what else do you have to determine when you're shopping for a home? You have to really narrow down what your needs and your wants are. What is most important to you? Do you have a 5-person family and you absolutely need 2 to 3 bathrooms? Then that's a priority for you. Also, maybe having 3 or 4 bedrooms is a priority for you. If you're a couple and you don't plan on having any kids, if you want all of your housing on the same floor because you don't do well with steps, those are things to keep in mind. What your social life is like. So do you like to entertain large groups of people? Do you want a house that has more of an open format for that? Or do you like to have your quiet places throughout the house so that maybe it's not as open floor, but you've got a number of little rooms that you can make your little spaces. So it really is a matter of preference. And this is something you want to talk to your real estate agent about. And that's why it's important to have that good relationship with them, so that you can feel comfortable enough to be honest with them and then trust the fact that they're going to look for what you asked for and not what they think you need. So when you're going house hunting, what should you remember? Well, you should take pictures and notes to help you remember the features of each home. Because sometimes if you look at a lot of houses on the same date, they can kind of blend together. You can forget which details you liked and didn't like. And now you may be making an offer on a home that you thought was the other one. You also want to avoid being distracted by things that are easy to change. So you walk in the front door and the seller's agent has the house smelling like chocolate chip cookies, and there's candles everywhere, and there's beautiful paintings, and it's just a great space to be in, and it's so enticing. However, all of those things are going out the door and not going to be part of your purchase. So you really want to get a sense for, are the rooms the format? is that something that fits your needs? Can you see yourself there, and with either your furniture or with what your plan is going to be for that house? It does make the point here of visiting homes more than once before making an offer. And that is a good rule of thumb. In this market right now, it tends to be if you find something you like, you better make an offer right away, is what most agents will tell you. This is going to be a decision for you. The reason you want to visit a home more than once is, in most cases, is just to have a night to sleep on it, come back and say, you know what bothered me before, I'm fine with it. Or what I liked before, I don't like so much now. Maybe this isn't the place for us. And then the last thing always applies. Don't ever admit that you found the perfect residence. Why? One, it takes away your negotiating power if the agent is aware of the fact that you'll do anything to get this property. And two, it sets you up for disappointment. Because if you don't get that property, you may feel like your world's going to end. And there have been cases like that before where people are just so devastated by the fact that this was the one and now I missed it and there's never going to be another one like this. There's another one like that. There's no perfect residence. What makes it right is you when you move in and what you do with it. So now, how do you submit an offer? Well, what are the components of an offer? It's the purchase price, so what you've agreed to purchase it for. The closing date, so what date that all parties will agree that settlement will take place and the transfer of ownership will happen. The offer expiration date, so basically, I'm putting in an offer here. Now, I want you to tell me within the next 5 days if you're going to accept it, because if you're not, I'm going to move on to another place. So an expiration date for the offer is in place as well. Then there's concessions. Now, in most cases, this refers to costs that the seller will pay for you, like closing costs, give you cash back, maybe to do some paint or repairs, perhaps give you some funds for the homeowners association dues that are going to be coming up. Again, in this market, which is considered a seller's market, closing concessions are not quite as predominant as they used to be, where the seller is basically enticing you, saying, I'll give you some of the money back if you buy this house for this price. I'll give it to you so that you can pay some of your closing costs. Now we're seeing more often that to be competitive, a buyer is saying, seller, I'll pay some of your costs so that you will accept my offer. So that's something to discuss with your agent and see what's really representative of the area you're looking to make a purchase and what's going to get your offer taken seriously. Another component of an offer is the inclusions, or what the seller leaves. They may say, you know what, you can have the hot tub, you can have the pool table, you can have the fireplace. I don't want to take them with me. So that would be included on the contract that says they know that they're leaving that for you. There's also contingencies that are listed on the contract, contingencies that are meant to protect you as the buyer. So conditions that have to be met. A home inspection. A home inspection is not the same as an appraisal. A home inspection is when you, the buyer, and your agent have a home inspector go into the home after you've made the offer, after the offer's been accepted, and the home inspector will inspect everything with as fine a tooth comb as they can in a 3-hour period to let you know if there's anything about this house that you need to be aware of as far as a serious concern with maintenance. Perhaps there's mold, water damage. Maybe there's the age of the roof. Is that going to have to be replaced soon? The air conditioning, is that something that's going soon? Assuming that the home inspection, whatever that report comes back at, and you're fine with that, then you would proceed with the contract. But you usually have only a certain period of time to get an inspector in there and make that. That's written into the contract. Another contingency is financing. So unless you have the cash to pay the property, then you might have a mortgage contingency on there saying, my buying this house is contingent on the fact of a lender approving me for this loan amount. If a lender doesn't approve you for it, and you've made a good faith effort to do that, then you may be able to get out of the contract at that point without losing money. And then there's the appraisal. Normally what you want is you want the house to appraise for what it is that you're paying for. The appraisal is going to determine that for the lender, what the market value, the established market value of the home should be. And the appraisal can determine whether or not you're underpaying, overpaying, and it gives you a protection if you say the house has to appraise for the purchase price, or we have the ability to negotiate the price again, or I'm walking away. In this housing environment, that the appraisal contingency has been kind of going to the wayside, and you do that at your own peril. But there's a lot of people that are willing to overpay significantly for homes at this point in time, and you have to make a decision if that's something that you want to do. Now, what other fees are we talking about? Apart from the down payment, you have the closing costs. These are the costs that are required to get the loan. So what are these fees? Well, typically a lender will charge a loan origination fee. So basically it's like an application fee to underwrite the loan, to approve the loan, to process the loan, and close the loan. Now, Ardent has a flat fee for that, which is $895, regardless of what the loan amount is. Other lenders have different fees, and sometimes it's just a percentage of the loan amount. So if it's a $400,000 loan, they may say we're charging 1% or 1 point. So their fee is $4,000. That's why you do want to shop lenders, because that's the fee that will change from lender to lender. The other fees that are listed here are not really going to change. Points are if you're going to be buying down the rate. Most borrowers don't do it. That's something you would talk to a loan officer to see if it's worthwhile for you to pay additional funds at closing to lower your rate, therefore lower your payment. But it's only really worthwhile if you're going to stay in the house long term and you're going to keep that loan for long term. So again, you can talk to your loan officer about that. There's the title search and insurance. So a title company will do a record background check on you as the borrower. They'll also do a background check on the property itself so that the lender is assured that there's no outstanding tax liens or anything else that could impact the lender's ability to put the mortgage on the property, and nothing else that would impact you as the buyer from perhaps previous owners of the property who now suddenly want to put in a claim once the property becomes yours, and now you've got an issue. So title search and title insurance, its purpose is to make sure that you have clean title, you get that property in your name, and that there's no issues that you're inheriting from the prior owners or from the property itself, if there's some type of a tax lien or anything like that. There's the appraisal fee. There's also a survey fee, which the survey fee is up to you if you want to pay that. Most people get a survey to determine their property boundaries, but that's your choice whether or not you want to do that. There's also, there's a recording fee to record your name with the county and your mortgage. And then there's the mortgage interest fee, which is charged based off of what day of the month you're going to be closing. But again, your loan officer can go over that with you. So what about making an offer? How does that part of it work? Well, your real estate agent is going to present the offer to the seller. It's customary at that point in time when you're making that offer that you put a good faith deposit with that offer. So what does that typically average? It's between 1% and 3% of the purchase price. It's not something that's given directly to the seller. It's something that's put in an escrow account with the title company. So they kind of hold it there until such time as closing takes place, and then they'll go ahead and release the funds as part of your down payment. So what will happen then? Well, the seller will either accept, reject, or counter the offer. And then at that point, once your offer is accepted, it now becomes a binding contract. So the parties can't just walk away without one of those contingencies that we talked about coming into play, like the inspection, the mortgage commitment, or perhaps the appraisal. So what do you do before you go to closing? Your contract has been accepted, or your contract has been signed, your offer's been accepted. So now what are you doing? Well, you've already done a lot of the legwork with the lender by providing them your assets, your credit, your proof of income. So that part of it's done. You don't have to really concern yourself with that. Your main concern now is getting yourself ready for that move. You want to have that home inspection done. A lender's not going to require you to have a home inspection, and a lender does not need you to send us the home inspection report. This is for your peace of mind, but I'm telling you, you should get it done. It's probably going to cost you somewhere around $500, but it is worthwhile to know what you're inheriting and what you need to take into account in the future. If you've got a $10,000 roof bill coming up in the next 24 months, you're going to want to know about that. What you're also going to want to do during that pre-closing period is to notify and periodically check in with your lender. Now, your lender should keep you updated with any notable events that are occurring, such as the appraisal being ordered, the appraisal being scheduled, the appraisal coming in, the title insurance coming in. The lender should be keeping in touch with you about any perhaps updated documentation they need, like your latest pay stub or something along those lines. So they should be checking in with you, but if you haven't heard from your lender in a week, check in with them just to make sure everything's going smoothly. You're also going to want to, during this time, to shop for homeowners insurance. You're required to have homeowners insurance as part of the mortgage. So you are free, though, to choose whoever you want as a homeowners insurance provider. And insurance policies can vary greatly between providers. So don't go with the first one that you see. Absolutely, it behooves you to get different quotes because they're going to have different premiums that they charge based off of their tables. You also want to avoid taking on additional debt. So if you can avoid opening credit cards, if you can avoid taking out that personal loan that you really don't need just now, if you can avoid buying that car, that would be a good idea for the time being, just because if you take on an additional debt, the lender will see that you've opened new credit, and now that could impact your pre-approval for the mortgage because they have a new debt to take into account. And then if you have two or more owners, you have to decide how to hold title, whether it's going to be tenancy by entirety, joint tenancy, tenancy in common, how the title is going to be held. And that's something you go over with the title company. They walk you through that. And then right before closing, usually the day of, you do a final walkthrough of the property. So after everything's been cleaned out and you're getting ready to move in, and right before you're about to sign all the paperwork, you get to walk in the property and inspect it to make sure that there's no damage that you weren't aware of that now needs to be fixed. And then when you finally get the closing, that's the day that the loan is finalized and the title of that home transfers to you. You're going to get a closing disclosure before closing that's going to tell you exactly what your closing costs are that you have to bring. It should not differ dramatically from the loan estimate you received at the very beginning of the process when you chose that lender and they quoted you based off the home that you wanted to purchase. Now, what are you going to sign at closing? The mortgage note itself for the loan, the mortgage or deed of trust titling the loan in your name, the closing disclosure, which has the closing fees, and then various affidavits acknowledging your responsibility on the loan and your responsibility as a homeowner as well. Now, Ardent offers the First Home Concierge program, which is a free service for all members, and it really is designed to do something like this program, but on a more intimate level, one-on-one, to help new buyers navigate that road to home ownership. So, like I said, you work one-on-one with either myself or another one of our team, and you're really going to receive unbiased guidance to reduce that stress and uncertainty. What do we mean by unbiased? If you don't choose Ardent for the mortgage, are we going to turn you away? No. We're going to help you to the best of our ability to understand the process so you feel comfortable with it. Sometimes we're the best deal that you can get. And other times there may be someone else that has offered something that we can't match, but it does seem like a deal that's going to benefit you. And we can give you that unbiased guidance and say, you know what, that looks like it's a good step for you. And then finally, you've gone through that entire process and an hour of hearing me talk, and that's the payoff. That you're going to be in your new home, and you finally get to do all the decorating and worry about all the other things that come with home ownership, like the toilets clogging on a regular basis, or the new leak in the ceiling downstairs, and so forth. But it is nice to have a piece of your own to call your own. So at this time, I think we're at the end of the webinar, the time that we had scheduled. So it doesn't look like there's a lot of time for questions, but I will say that we can give you my information. If there's anything you want to reach out to me personally about, we can discuss that at a separate time in a different environment.
Damien, we do just have one question that's been coming through, so I think it's important. That's why maybe just take a minute. And the question is, what's the number one mistake you think first home buyers make?
The number one mistake I think first-time home buyers make in this current market is overpaying for a property because they're just so anxious to get the home. And now they wind up being basically underwater on a property or paying a lot more of their funds that they had set aside for another reason, just so they could field a competitive offer. We're seeing that a lot right now, and it is a big concern. And that's something that you want to talk to your agent, you want to talk to your lender about before you're going to do something like that. Get all the facts before you make the determination that that's the best move for you. It may be a good move for you. You may have plenty of assets and that's not an issue for you. But it is something that you want to weigh in the balance and get good advice on before you make that decision.
All right, and that was all the time we have for questions, Damien. Thank you.
All right. Thank you again, Damien and Lisa. You can find more information on Ardent's First Home Concierge under the Borrow menu at ardentcu.org. And we would like to thank everyone for attending tonight. There will be a brief survey sent out shortly, and we would love to hear your feedback to help us improve future workshops. Thank you again, and have a great evening.